So what can you be doing now to potentially mitigate your capital gains tax liability? First of all, number one, I would say, is to optimise your ISA and your pension allowances. Because don't forget, your capital gains made within these tax-friendly vehicles, so your ISAs and your pensions, will not incur any charges. Now, specifically, using ISAs means that you can access those funds immediately should you need it, whereas pensions are slightly different. So I would utilise these vehicles first and foremost. Number two is sell any shares that you might have outside of these wrappers and incorporate those into the tax-free wrappers. Okay, so in effect what you're doing is you are liquidating and making a disposal for capital gains purposes. So be aware that there may be a charge, but then what you're doing is you're incorporating them into a tax efficient vehicle. We call this bed and ISAing, again, which is under the tax efficient way of holding your investments. The third point is to use your spouse or civil partner's allowances. Now, it might be the case that they have a lower tax bracket than you, and don't forget that you can transfer investments between spouses without incurring a tax charge. So using a spouse's allowance when they're a lower tax bracket gives you that extra headroom to mitigate your liability. And the fourth point is act now, or certainly before these changes come into place. So crystallise any gains before the budget in autumn. Take advantage of your £12,300 tax-free capital gains allowance, and again the proceeds could be used to fund an ISA or a pension. So there are the four main points. If you require any further information, please let me know.